Imagine a company, right? It's got one foot firmly planted in this world of NASA-backed space-age technology, so, helping conquer Mars.
Right.
And the other foot, it's stepping boldly into the super volatile world of cryptocurrency, tying its whole financial future to Bitcoin.
Mhm.
Is this company a pioneering innovator, or is it just a really high-risk speculative bet? That's kind of the fundamental question we're trying to unpack today.
It really is.
So today we're doing a deep dive into QLR Technology Group, tickers KULR, trading on the NYSE American. Our mission really is to cut through all the noise, analyze this company from, well, every angle, the business, the financials, management, the risks, which seems significant.
Definitely.
We want to give you the most important insights from our research, all anchored to June 26, 2025. That's when QLR closed at $5.19 per share.
And our goal here isn't just to list facts, right? It's to help you understand why these facts matter for this really unique company. We want to give you the tools, the questions, so you can form your own informed view. Absolutely. And hey, for more deep dives like this one, remember to like and subscribe to the Stock Analytics AI YouTube channel. Members get priority on deep dives for specific tickers, and actually, over the next few months, we're covering all of the S&P 500 stocks. Members get exclusive priority access to those.
That's a big project.
It is. And if you just want a one-off deep dive on a stock you're interested in, you can always drop us a super sig.
Thanks.
Okay, let's peel back the layers. Let's start with what KULR actually does.
Let's do it.
All right, we're kicking off with Chapter 1, Business Understanding. Now, if you just glanced at KULR's stock chart, say, late June 2025, you'd see something pretty wild. A huge price surge, jumping from around, 87 cents to over $6 in just a few days.
Yeah, it looked dramatic.
So what was the big breakthrough? Did they suddenly, invent cold fusion?
Yeah, you'd think so, wouldn't you? But what's really fascinating here is that it wasn't a fundamental breakthrough at all.
No.
No, that apparent surge was basically the direct mechanical result of a 1-for-8 reverse stock split. That went into effect June 23rd, 2025. Okay, explain that. Reverse split.
Think of it like this. You have 8 $1 bills,
Okay.
right? You exchange them for one $8 bill. You've got fewer pieces of paper, but the total value, exactly the same.
Oh, okay.
So the company's total market value, the market cap, didn't change. It just meant fewer shares were out there, each trading at a proportionally higher price.
So if it doesn't actually change the company's value, why do it? What was the strategy behind that move?
Well, the CEO, Michael Moe, he stated the goal was to, quote, broaden investor appeal and better position for broader institutional participation.
Meaning?
Meaning a lot of big investment funds, institutions, they have rules, right? They often can't buy stocks trading below a certain price, like maybe $1 or even $5. So by bumping the price up, KULR was basically trying to get itself onto the radar, onto the buy lists of these bigger pools of money, opening doors, essentially.
And the timing. That wasn't random, was it? It felt almost like a calculated move.
Oh, absolutely calculated. This reverse split happened just days before KULR was confirmed to be included in the Russell 3000 index, which took effect June 30th.
And why is that inclusion important?
It's key because index funds and ETFs that track the Russell 3000, they're essentially forced to buy the stock once it's in the index. It creates automatic demand.
Ah, I see.
So
Yeah.
what's really interesting here is how this corporate action, the split, became sort of a strategic necessity, not really a sign of underlying strength. It was a clever gambit by management. They solved a potential delisting problem and amplified the buying pressure from that Russell inclusion. They used the split to get ready for that forced buy.
That's crucial context, turning accounting into strategy. Okay, let's dig into the core business itself. It sounds like it has a lot of different parts. Can you break down how they actually make money?
Sure. KULR operates with basically 4 distinct revenue streams. It paints a picture of, well, both genuine innovation and this really unusual financial pivot. First, you've got product sales. These are their own proprietary thermal management and battery safety products. Things like, flight-ready battery packs for demanding missions.
Right.
Second, contract services. This is high-margin stuff engineering, design work, advanced battery testing. And interestingly, this is often a lead indicator for future product sales, because clients test with PLR before committing to buying their products.
Makes sense.
Third is technology licensing. They monetize their intellectual property, their IP, like something called KULR Zero Vibe.
Yeah.
And fourth, this is where it gets, really interesting, their Bitcoin treasury strategy. They started this late 2024. They decided to allocate up to 90% of their surplus cash to buying Bitcoin.
Wow. Where's that cash coming from?
Primarily from selling new shares of their own stock continuously through what are called at-the-market or ATM offerings.
Ah.
So, yeah, this raises a really important question for investors.
Mm.
What does this strange dual strategy actually mean? You've got this high-tech company that's also acting like a kind of Bitcoin fund.
A Bitcoin-first strategy for a thermal management company.
Yeah, that definitely
Mm.
stands out. Can you give us some concrete examples of the high-tech products they actually make?
Yeah, absolutely. So in battery safety, they have things like the Thermal Runaway Shield, DRS, and Safe Case products. These are designed to contain catastrophic lithium-ion battery failures, prevent fires.
Okay, critical stuff.
Very critical. For thermal management, they're known for their carbon fiber thermal interface, FTI, and phase change material, PCM, heat sinks. The PCM tech was famously used on NASA's Mars Perseverance rover.
Mars rover, wow.
Yeah, think about the crazy temperature swings on Mars. That give you a sense of the engineering challenge they can handle. They also offer integrated platforms like KULR for space, defense, and aviation uses.
Okay.
Plus, through an acquisition, they added KULR Vibe for reducing vibrations, and they're even branching out into new areas like AI-powered exoskeletons, working with a company called German Bionic, and also a Zero Vibe fan specifically designed for cooling AI data centers. Show some adaptability. So lots of specialized, very high-tech products for really demanding customers and environments. Given that, where do they sit in the market? Are they a big player? What's their scale?
Well, KULR is definitely a niche player. It's a small cap, actually micro cap company, market
Mm.
value around $203 million. They kind of brand themselves in two ways, which reflects that split identity we talked about.
How so?
On one hand, they're a global leader in sustainable energy management. On the other, they call themselves a Bitcoin-first company. It's unusual.
Mm.
Their core market position, though, is definitely in that high reliability segment for critical customers. NASA, the U.S. Department of Defense, Lockheed Martin, places where failure is astronomically expensive.
Right. Failure is not an option, like you said. So what's their core promise, their main value proposition to those kinds of customers?
It boils down to delivering unparalleled safety, reliability, and performance in extreme energy applications. They leverage technology originally licensed from NASA, and they create these custom, highly engineered solutions for really tough environment space, the battlefield, high-altitude flight. Their edge is delivering where others can't, especially under harsh conditions.
Okay, let's zoom out a bit to the broader industry. What's happening in the thermal management market and who are they competing against?
They're mainly in the battery thermal management system market, or BTMS. And that sector is seeing, well, really powerful growth, secular growth. Forecasts put the compound annual growth rate somewhere between, say, 14.7%, and some even predict over 30% by 2030.
Wow, why such strong growth?
It's largely driven by the massive shift to electric vehicles, EVs, and also the build-out of large-scale battery energy storage systems, BES, for power grids. Now, the competitive landscape itself is pretty fragmented. You've got giants like Bosch dominating the mass markets, like automotive.
So how does QLR compete with giants like Bosch?
They wisely carved out a niche, a high-performance niche focusing on aerospace and defense. In those areas, extreme reliability and custom engineering often matter more than just the lowest cost.
Right.
So connecting this to the bigger picture, that niche focus helps them avoid going head-to-head with the titans who operate on a totally different scale. Plus, they benefit from regulatory tailwinds, stricter battery safety rules, incentives like those in the Inflation Reduction Act.
What about barriers to entry? Is it easy for someone else to just jump into QLR's specialized corner of the market?
No, not easy at all. There's significant technological complexity, requires really deep engineering know-how, and maybe even more importantly, there's this huge need for validation and trust.
The NASA connection again?
Exactly. A new company just can't easily replicate QLR's decades of NASA validation. That's as a gold standard. Plus, the R&D and testing costs to develop and prove these mission-critical systems are really high. So QLR's intellectual property, their patents, and that NASA stamp of approval are key advantages. They act as pretty strong barriers in their niche.
Okay, that leads nicely into their competitive advantage or their economic moat, as some call it. How does QLR actually sustain its edge over time?
Their strongest asset, without a doubt, is their brand strength. And that's tied directly to that NASA validation, the ISS, the Mars rover. Being NASA validated is just a massive differentiator in these high-stakes markets.
Okay, what else?
Well, on the flip side, they have no real cost advantages. They're a small cap, they lack scale. And you see this reflected in their gross margins, which have been, frankly, all over the place. highly volatile,
Yeah.
sometimes severely compressed, like that shocking 8% figure in Q1 2025.
8%. Wow. What did they say caused that?
Management blamed unanticipated labor hours. But, that raises a really important question. Can they actually control these costs as they try to grow? Or will poor execution keep dragging down their profitability?
It's a key concern.
Okay, so brand strength, yes. Cost advantage, no. Anything else? Yes, they benefit significantly from high switching costs. Once their tech is designed into a long-term platform like a missile system, or a satellite, ripping it out and replacing it is incredibly expensive and time-consuming for the customer.
So it creates sticky revenue.
Exactly. Sticky and recurring revenue. And finally, their unique assets that include their patented IP, especially the carbon fiber-based stuff, and their vertically integrated capabilities, design, testing, production, all now consolidated in Texas.
That gives us a really solid picture of the tech and the market. Now, let's shift gears and look at who's actually steering the ship here. Next up is Chapter 2, Management Evaluation. What's your assessment of KULR's leadership, especially given these bold strategic choices?
Well, the company's led by co-founder and CEO Michael Moe. He's been there since 2011. His really defining decision, the one that will shape his legacy, is that radical strategic pivot to becoming Bitcoin first in late 2024. Whether that turns out to be visionary or just reckless, time will tell.
Has the team shown they can handle challenges?
They have shown some capacity to respond to crises, yeah. They successfully pulled off that reverse stock split to keep their NYSE listing when the price got too low. They also consolidated operations down in Texas, which involved a leadership change. The COO resigned back in August 2024. So it shows a willingness to make some tough organizational calls.
What about transparency, especially with this unusual Bitcoin strategy? Are they upfront with investors about what they're doing?
They've actually been exceptionally transparent about the Bitcoin strategy. They even created a custom non-standard metric they call BTC yield to track it.
BTC yield.
Now, while that sounds transparent, you really need to look critically at what that metric does. BTC yield essentially frames a highly dilutive process selling your own company's stock to buy a speculative asset like Bitcoin in a positive light.
How so?
Remember, the company isn't profitable. It burns through cash. It relies on constantly selling new shares via those ATM offerings. BTC yield calculates the percentage change in their Bitcoin holdings period over period relative to their assumed fully diluted share count.
Yeah.
Well, it's a masterful piece of financial narrative construction.
So it shifts the focus.
Exactly. It shifts the focus away from maybe poor operational performance in the core business and points instead to the speculative gains or potential gains in crypto. For a more conservative investor, this is a significant red flag. It's storytelling over substance, potentially.
Okay, let's talk capital allocation. That's always crucial. How is KLR actually using its resources? Where's the money going?
Well, they're definitely investing in their core tech. You see that in their R&D spending, their SG&A expenses, plus that VibeTech acquisition they made. But, and this is a huge but, the most significant capital allocation decision recently has been diverting up to 90% of their surplus cash into Bitcoin.
So prioritizing speculation over reinvesting in the main business.
It certainly appears that way, yeah. Now, they don't pay dividends or buy back shares, which is totally appropriate for a company that's not profitable yet. But the stark contrast between not doing those things and then aggressively buying Bitcoin, that's really the central point of contention here.
How does this show up in their returns, like return on invested capital?
Oh, yeah, ROIC. Yeah, that tells a pretty sobering story. It's deeply negative. For the trailing 12 months, it was somewhere between negative 25.7% and again at 31.5%.
What does that mean in simple terms?
It means for every dollar KLR invested back into its operations, it was generating an operating loss of about 26 to 32 cents annually. They were losing money on their investments, not making it. That highlights just immense risk in the current operational model.
Okay, that's a lot to digest on strategy and management. Let's now dive into the hard numbers that back all this up. Time for Chapter 3, Financial Performance. Can you give us the overall financial snapshot? What's the big picture here?
Sure. The big picture is one of really explosive top-line revenue growth historically, but combined with pretty significant profitability challenges and this heavy reliance on external financing, mainly selling stock. Their market cap, as we said, is around $203 million, putting them squarely in that micro-cap zone.
Which means
higher growth potential, usually, but also much higher volatility and risk compared to bigger companies.
Okay, let's talk revenue growth. You said explosive. What have the trends looked like over the past 5 years or so?
Yeah, from a very small base, the growth was remarkable for a while. They went from like $0.62 million in 2020.
Tiny.
Tiny.
Yeah.
To $2.41 million in 2021, that's up 287%. Then $3.99 million in 2022, up another 65%. Then $9.83 million in 2023, up 146%. Just incredible growth rate.
There's always a but, isn't there?
There often is. After those years of just breathtaking surges, growth hit a wall in 2024. Revenue only grew 9% that year, reaching $10.74 million. That dramatic slowdown from triple digits down to single digits is a really critical data point. It's a potential red flag that hyper-growth phase might be over or maturing.
Okay, growth slowing dramatically. What about profit margins? Are they actually making money on the products and services they sell?
This is where the picture gets pretty concerning. Gross margin, which is just revenue minus the direct cost of goods sold, has been highly volatile.
Like we talked about before.
Exactly. It swung from a reasonably healthy 44% in Q3 2023 down to that shocking 8% in Q1 2025. Again, management blamed unanticipated labor hours, but it suggests real issues with costing or execution or both.
And below the gross margin line, operating and net margins.
Consistently and deeply negative. For the full year 2024, they had an operating loss of over $15 million and a net loss of over $17 million on just $10.74 million in revenue.
Wait, say that again?
They lost about 1.63 cents for every dollar of sales they made in 2024.
Wow. That's not sustainable.
It shows a cost structure that is just nowhere near sustainable right now.
Okay, that sounds like they must be burning through cash pretty fast. What's the free cash flow trend look like? Are they funding themselves?
Not even close. It's been significant and sustained negative free cash flow, what people call cash burn. It went from about negative $2.8 million in 2020, growing worse pretty much each year, hitting negative $17.9 million in 2024.
And that's why they keep selling stock.
That is exactly why they have to continuously raise capital by selling equity. The core business just doesn't generate enough cash to support itself, let alone grow.
Let's shift to financial stability then. Are they taking on lots of debt to plug these holes, or is there something else going on?
This is actually one area that looks strong on the surface, but you have to remember how it got that way. Their debt-to-equity ratio is practically zero, like 0.01%. They barely use debt. They rely almost entirely on issuing equity selling stock.
Which makes them less sensitive to interest rate hikes.
Yeah. Exactly. Very resilient to rising rates, unlike heavily indebted companies. Yeah. Their current ratio, that's current assets divided by current liabilities, is also exceptionally high, somewhere between 7.3 and 9.2.
It's a big safety cushion.
It indicates a very large cushion of liquid assets, yeah. But again, where did that cushion come from? Mostly from selling stock to investors, not from profitable operations. And obviously no dividends. They don't pay them. Nobody expects them to, given the losses in cash burn.
Okay, so with negative earnings, slowing growth, this weird dual strategy, how on earth do you even begin to value a company like KULR?
Yeah, it's exceptionally challenging. And frankly, some of the standard valuation metrics, they just don't work or aren't meaningful here.
Like PE ratio.
Exactly. Price to earnings is useless when earnings are negative. Price to sales, or PS though, that gives us something. It's around 15.8.
Is that high or low?
That's generally considered quite high. It indicates that the market is pricing in or expecting extremely strong future revenue growth to justify that kind of multiple on current sales.
What about trying to figure out its intrinsic value, like with a discounted cash flow model?
Right, a DCF. That's the standard approach for intrinsic value. You basically try to forecast all the future free cash flows the company might generate, add a terminal value for the cash flows way out in the future, and then discount all of that back to what it's worth today using an appropriate discount rate. It's complex.
And what did an educational DCF model suggest for KULR? I know you mentioned alpha spread earlier.
Yeah, an alpha spread model, before that reverse split happened, it calculated an intrinsic value around $5.02 per share. Now, if you adjust that for the 1-for-8 split...
You multiply by 8.
Right. It implies a theoretical intrinsic value of roughly $40 per share.
Okay, wait. $40. Compared to the actual price of $5.19, that sounds like it's massively undervalued. Why isn't everyone piling in?
Hold on. That's the crucial point. You absolutely have to look at the assumptions baked into that $40 DCF number.
And they are.
They are. Let's call them heroically optimistic. It represents an absolutely best-case, everything-goes-perfectly scenario.
Like what kind of assumptions?
Like revenue growing from about $23 million now to over $680 million in just 5 years. That's nearly a 30-fold increase.
Whoa.
And it assumes net profit margins swing dramatically from deeply negative, like negative 69%, to highly profitable, like plus 28%.
Okay, that does sound optimistic.
Heroically so.
No.
Think of that $40 valuation like a stunning architect's drawing of a mansion. Looks incredible on paper. But the market's current price, that $5.19, is essentially saying, yeah, nice drawing, but we're not sure they even own the land yet, let alone have the permits or the gross to build it.
So the huge gap isn't necessarily a buy signal.
Not necessarily. It's more a reflection of the market's profound skepticism that QLR can actually achieve those incredibly ambitious assumptions. Taking that $40 headline number at face value would be, frankly, dangerously misleading.
Okay, that's a really important distinction. We've looked inside QLR, the tech, the strategy, the finances. Let's now shift our gaze outward to how the market perceives it. This brings us to Chapter 4, Market Sentiment. What are Wall Street analysts saying? Is there any consensus?
Consensus? Not really. The analyst views are, well, kind of all over the place. Wildly divergent, actually. It signals deep uncertainty.
Give me some examples.
Okay, one source, Zacks, had an average price target way up at $27.40. Now, that might be based on older pre-split data, so take it with a grain of salt. Another source, Fintel, had a much more recent and sober target of $5.61.
Closer to the actual price?
Much closer. The general consensus rating tends to lean towards moderate buy or even strong buy, but those price targets just show there's no real agreement on what it's worth.
How does news impact the perception?
Well, the company's own announcements, the split, getting into the Russell 3000, the Bitcoin buys are clearly promotional, designed to generate positive buzz.
Yeah.
Independent media, like maybe the Motley Fool, they've been more cautious. They correctly pointed out the reverse split was the main reason for that big price jump, not some fundamental improvement.
And retail investors? The chatter online.
Oh, highly polarized. You see fervent hope for things like a short squeeze driving the price up, mixed with real fear about the ongoing dilution from all the stock sales. It's a battleground.
Okay, let's look past the opinions. What do the cold, hard, technical market indicators tell us? Bullish or bearish?
Overwhelmingly bearish, unfortunately.
Really? How so?
First, short interest is very high. It stands at 15.51% of the available shares, the float. That means a significant chunk of the market is actively betting against the stock that the price will go down.
That's a big number.
It is. Then you look at the price relative to its moving averages. The current price, $5.19, is way below its 50-day moving average, which is around $9.62. That's a bearish signal for the short term.
And long term.
Even worse, it's far below its 200-day moving average, which is hovering around $10.21. That's a strong long-term bearish signal. When you put it all together, high short interest, price well below key moving averages, the technical picture looks pretty weak for the stock right now. It suggests strong headwinds.
Okay, so market sentiment is leaning negative. Let's move from the mood to who actually owns the company. Next up, Chapter 5, Ownership Structure. What does the breakdown of shareholders look like for QLR?
Well, one of the most striking things here is the exceptionally low institutional ownership.
Oh, low.
Different data sources show slightly different numbers, but it's somewhere in the range of just 0.6% to maybe 8.9%. That's really, really low for a publicly traded company on a major exchange.
And that's a red flag.
It's generally seen as a significant red flag, yeah. It suggests that sophisticated large investors haven't bought into the story yet or are avoiding it. And it clearly explains why management did things like the reverse split. They're desperately trying to attract that institutional money.
Who are the biggest institutional holders then, if any?
It's primarily passive index funds. Like Vanguard is often listed as a top holder. But they own it because KULR is now in an index they track, like the Russell 3000. It's not necessarily because Vanguard actively decided KULR was a great investment. It's forced buying.
Okay, what about insiders? Management, board members? How much skin do they have in the game?
Insider holdings are relatively high, actually, around 14.5% overall. The CEO, Michael Moe, is the biggest insider, holding about 6.9%.
So on the surface, that looks like good alignment with shareholders.
On the surface, yes. High insider ownership usually suggests they believe in the company. However, you also have to look at recent transactions. Are they buying more or are they selling? Lately, there's been more selling reported than open market buying from the current leadership team. Now, some sales were by a former executive, and the CEO and CFO sold some shares for tax liabilities, which is pretty normal. Doesn't mean much.
But no big buys.
But the absence of any recent significant open market purchases by insiders, especially when a stock price has been depressed, that's a notable data point. If they truly believed it was doubly undervalued, you might expect to see them buying more.
So if institutions own very little and insiders aren't really buying much, who owns the rest?
It means ownership is highly concentrated among those insiders and the general retail investor public. Everyday people buying shares.
And what does that concentration mean for the stock?
It contributes significantly to the high volatility we see. With a low institutional presence, the stock is much more susceptible to big price swings based on news, online sentiment, maybe short squeezes rather than, disciplined analysis of the fundamentals.
Right. Every investment carries risk, but KULR seems to have this really unique blend, mixing high-tech promise with high-stakes speculation. Let's break down those risks systematically in Chapter 6, Risk Assessment. Maybe start with a SWOT analysis, strengths, weaknesses, opportunities, threats. What are KULR's core strengths right now?
Okay, strengths. They definitely have proprietary NASA-validated technology that's huge. This gives them sole source potential in some areas and creates those high switching costs we discussed. They also have what looks like a strong balance sheet. Virtually no debt, lots of liquid assets.
But that liquidity comes from selling stock.
Exactly. That's the asterisk. You have to remember where it came from. And finally, their core tech is exposed to some really big, high-growth markets. Electrification, space, maybe even AI infrastructure cooling.
Okay, now the flip side. What are the major weaknesses?
The weaknesses are pretty significant too. There's that long, unbroken history of net losses and substantial cash burn. There's the resulting reliance on dilutive financing, constantly selling more shares, which hurts existing shareholders. There are those volatile, sometimes terrible gross margins, like that 8% number.
And the elephant in the room.
And, of course, the unproven and, let's face it, highly risky Bitcoin strategy diverts capital, it diverts management focus, and it adds massive volatility. Plus, that persistently low institutional ownership is a weakness in itself.
All right, what about opportunities? Where could things go right for KULR?
Well, that electrification megatrend is a massive tailwind for their core battery safety and thermal tech. Expansion into new areas like AI data centers or exoskeletons could open up new revenue streams. And then there's the Bitcoin angle again.
The call option.
Right. There's this asymmetric upside potential. If Bitcoin went on some massive bull run, the gains could, theoretically, dwarf any profits from the core business. It's a long shot, maybe, but it's an opportunity. And finally, the Russell 3000 inclusion could eventually attract more institutional eyes, even if it's just passive funds initially.
Okay, now for the threats. What could really derail this company? Let's start with general business threats.
The most immediate and probably potent threat is Bitcoin itself, its volatility and the regulatory risk around it. If Bitcoin were to collapse, it would absolutely hammer KULR's balance sheet and severely damage management's credibility.
Makes sense.
There's also always the threat of competition, maybe from larger players deciding to target KULR's niche more aggressively. And there's the persistent, overarching threat that they simply fail to reach profitability. That would lead to a vicious cycle. More cash burn, more dilution, until the market just says no more.
What about broader macroeconomic threats, like inflation or interest rates?
Yeah, those matter too. Inflation obviously drives up their costs for materials, labor, squeezing those already thin or negative margins. High interest rates. Well, they don't have much debt, so that's not the direct threat.
So how do rates affect them?
Indirectly. Higher rates increase the discount rate used in valuation models like DCF, which tends to depress the value of growth stocks that have most of their expected earnings far out in the future. And maybe more critically for KULR, higher rates can make it harder and more expensive to raise capital. And raising capital right now is the lifeblood of their entire operational model.
Any specific geopolitical threats that investors should be aware of, given their tech focus?
Well, thinking hypothetically, if we saw a renewal or a serious escalation of the U.S.-China trade war, say in 2025, especially targeting critical minerals or battery components, that could be a major headwind.
Why specifically?
Because China dominates the processing of many key materials used in batteries. New tariffs or restrictions could ripple through the supply chain, significantly increasing costs for KULR, potentially causing shortages or delays in their production. That's a risk for anyone in the battery ecosystem.
Okay, we have covered a lot of ground here, from space tech to crypto bets, surging revenue to burning cash. Let's try to bring it all together now. We're moving to our final section, Chapter 7, Synthesis and Outlook. Can you start by summarizing the bull case? What are the main arguments for investing in KULR?
Okay, the bull case, in a nutshell, is this. KULR is a pure-play investment in the critical, rapidly growing market for battery safety and thermal management. They have a defensible tech moat, heavily validated by NASA, leading to high switching costs and potentially sticky revenue. Their balance sheet, at least on the surface, looks pristine, lots of liquidity. The Bitcoin strategy, While risky, offers this potentially huge asymmetric upside, a call option on crypto. And they have a clear catalyst for institutional buying with that Russell 3000 inclusion.
Right. Now give us the counter argument. What's the bear case against KULR? What are the biggest red flags?
The bear case is equally strong, maybe stronger for many investors. It points directly to the unprofitable and highly dilutive business model. They perpetually burn cash and have to sell stock, constantly eroding existing shareholder value. There's the enormous Bitcoin gamble, this radical high-risk diversion that essentially turns KULR into a speculative crypto proxy, tying its fate to a wildly volatile asset. We see deteriorating fundamentals in the core business, like those collapsing gross margins, suggesting a really challenging path to profitability. And finally, there's that overwhelmingly negative market sentiment reflected in the broken technical chart and that persistent high short interest.
Let's just circle back to that valuation point one last time. The DCF model, even with those heroically optimistic assumptions, spit out a theoretical value around $40 per share post-split.
Exactly. And it's so important to reiterate that $40 is a perfect world scenario. It is absolutely not a realistic price target. Think of it as the absolute ceiling, the maximum possible value if every single ambitious plan succeeds flawlessly, if they hit every growth number, if margins magically improve, and if Bitcoin cooperates massively. A lot of ifs.
So, wrapping it all up, what does this mean for you, the listener, the potential investor, looking at QUAL today trading at $5.19?
Well, at the end of the day, KULR is a classic high-risk, high-reward proposition. But it's amplified to an extreme degree because of this dual identity, the tech company and the Bitcoin holder. That current share price, $5.19, yes, it represents a massive, almost unfathomable discount compared to that super optimistic $40 DCF value.
But that discount exists for a reason.
Precisely. That discount isn't some market mistake. It is the market explicitly pricing in all those substantial risks and the deep skepticism we've discussed. The unproven path to actually making money consistently, the destructive dilution from selling stock constantly, and the immense volatility and risk tied to their Bitcoin holdings.
So an investment today is really a bet on...
It's fundamentally a bet on management's ability to successfully navigate two entirely different, very challenging landscapes at the same time. You have to believe they can not only scale up their complex high-tech manufacturing business to profitability, something they haven't done yet, but also that their huge speculative bet on Bitcoin will pay off handsomely. The vast chasm between today's price and that pie-in-the-sky bull case valuation, it reflects a pretty strong market consensus right now that the probability of achieving both of those things successfully, well, it's low.
So here's a final thought to leave you with. When you consider KULR, really ask yourself, are you investing in the future of space technology and vital battery safety? Or are you essentially buying shares in a high-tech company that has morphed into something else, a very unique and arguably very leveraged Bitcoin ETF?
And just a reminder, this analysis was generated by an AI system. It's intended for educational purposes only and should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Don't forget to like and subscribe to the Stock Analytics AI YouTube channel for more deep dives just like this one. Remember, members get exclusive priority access to our upcoming coverage of all S&P 500 stocks. And you can always request a specific deep dive using Super Thanks.